This is the Earth to World Broadcasting Network.
Hi, welcome back to HFO Television. I'm Greg Frick, a partner with HFO Investment Real Estate. Today we're going to be talking with Joel Kaplan, Managing Director of the Oregon Law Group, about financing with Freddie Mac, specifically apartments. Joel's been in the real estate business for over 20 years, and his practice is focused on acquisition, financing, and development. He's closed over $1.5 billion of multifamily transactions over the past 8 years, and has included work on over 100 Freddie Mac deals in his history. I guess the first question is Freddie Mac back in the lending business, specifically on apartments?
Yeah, Freddie Mac is definitely back in the lending business. They're big time in multifamily. I think in some places, and for some deals, they may be about the only lender in town. But I've personally worked on probably a half a dozen Freddie deals in the last 6 months. When the economy melted down, Freddie's pipeline slowed down. They were very nervous. You couldn't get new loans out of them, or at least not like you could in the old days.
Right.
But they're definitely back. I think the multifamily lending has traditionally been and continues to be a very profitable part of Freddie. That's not where Freddie's problems were. Freddie's problems were in the single-family mortgage market. The multifamily credits have done very well. They clearly had their problems, but all in all, it's been a good business for them, and they want to stay in it.
So what have been the biggest changes from Freddie's standpoint since the meltdown? I mean, from a borrower that dealt with them before 2009, now they're dealing with them now. Is there big, significant changes in the program? I mean, I know multifamily's been the shining star, but I know there's been some issues. I'm just curious what the big differences would be.
I'd say two big differences. First, they're a lot more conservative on their underwriting criteria, as everybody was. You know, all the lenders got burned from the loans that are vintage 2006, 2007. Freddie's no example. It used to be, a couple of years ago, you could get Freddie to underwrite forward-looking rents. You could tell Freddie, we're going to put $1 million in, we're going to do a new swimming pool, slap a new coat of paint. Rents are going to go up. Freddie'd say, fantastic, let me underwrite that and I'll loan you the money. Today, they're only underwriting in-place rents, and you can talk to them till you turn blue about what you're going to do to turn this B property into an A, but they're not going to extend any money. So the underwriting criteria, obviously, more conservative. The other thing that happened was, when we had the economic meltdown, the securitization of mortgages came to a grinding halt. I mean, Freddie doesn't use its own money and hold these loans in their portfolios. They securitize them, they sell them off to Wall Street. That came to a grinding halt. For Freddie to get back in the business, they needed to get back into securitizing. Wall Street does not like risk, they don't like uncertainty. So what Freddie has done now is said, if you're going to borrow from us, here's the box. They call it the CME program, and you got to fit in that box. And they are extremely reluctant to move outside of the box. So they came out with a new set of loan documents, and we used to be able to negotiate the heck out of those documents. Today, Freddie requires you negotiate all changes you want to the documents before you sign your loan commitment. So it's very difficult to get Freddie to move out of that box.
So if it doesn't fit in the box, the latitude is nowhere near what it was before.
Yeah, that's right.
Yeah.
And one of the areas we've really found issues is in buy-sell provisions. This could be a couple partners own a property, they've got a buy-sell between themselves.
Right.
It could be a sponsor partnering with some institutional money. And the institution might have options to buy out the sponsor on a default or other circumstances. It used to be you could get Freddie to agree in advance that when that happened, you might pay us a couple $1,000s to review the paperwork, but it was a done deal. You could proceed, you could get it done.
Right.
Without an assumption fee, which costs you 1% of the principal balance. Today, Freddie will still agree in advance that you can do it. They want to now underwrite who the party is at the time of the assumption, but the big difference is a $50,000 minimum fee. And this is a new change effective February 1 of this year. The reason for it goes back to the securitization. What Freddie's lawyers have told me is the more changes you make to a mortgage, the lower rating it will get from the rating agencies.
When they go back out and securitize it. Right.
Exactly. So Freddie has two choices. When you want to tinker with the loan, they can increase the interest rate to the current borrower, or they can effectively tax the party that's going to assume the property at a later date in a transfer. And that's the decision they've made. So they're going to impose a tax of $50,000 when you want to implement a buy-sell down the road.
So now how's that affecting the loans done prior to the ones prior to the slowdown? Are they doing workouts? Are they being more, is they trying to fit that in the box now for the workout programs? Or are they a little bit?
No, they're not trying to fit those in a box because those have already been securitized and sold. What we are seeing, though, is in the fine print of a Freddie mortgage, there's a provision that says in connection with an assumption or any kind of workout, we've got the right to do effectively a de novo review of the underwriting. And what we are seeing occasionally is a loan that might have a $20 million balance. A strong borrower, a strong buyer comes in, somebody who's definitely able to buy this property, and they're picking it up for maybe $22 million, just a little bit above the mortgage. You file the assumption papers, Freddie's saying, not so much. If that property is worth $22 million, today we would only lend you $15 million, say. So they're requiring a buy down on that mortgage, which might blow up the deal.
Now, are they requiring a prepayment on the buy down amount? If there's a prepayment provision?
No, they'll waive the prepayment penalty.
To get it back, the LTV back in the
but they want to get it back down to today's underwriting standards, which is probably 60% on in-place rents.
Right. So, interesting. Okay. And what other? I know they had the. So they're having the 1%. That's the 1% transfer fee that's coming in place now.
The 1% fee has always been there.
This is on top of that.
Well, no, it's instead of it, but it's an exception for transfers among the owners.
Got it, okay.
If an independent third party comes in, there's always a 1% fee. We used to get away with, you and I are partners in a deal. You sell your interest to me, Freddie would say, give us a couple $1,000s for administrative expenses. Today it's $50,000.
Wow, okay. Wow, they got to cover. They got to cover themselves, though.
Yeah,
and we've had a lot of. What do you see? What kind of other lenders are you seeing coming back in the multifamily? I know we've talked about CMBS. Pretty much has died in 2009. It's slowly coming back. Are you seeing more of a push to get back there, or what's?
Yeah, I represent a couple sponsors who go after institutional money, and the institutional national level real estate equity funds. They've got money burning holes in their pockets. They desperately want to get into multifamily. They've got huge allocations. Difference is, just like we've been discussing with Freddie, it's so much more difficult today. The underwriting they're doing is more careful from A to Z. The environmental underwriting, the condition assessment, the money's there, but the deals are harder to put together. And I'm also seeing other lenders coming back into the multifamily market, including construction lending, and they're putting together syndicates to protect themselves, get a few other banks to share in the risk, but everybody's definitely coming back, but slowly, and they still remember 2008, 9, and things aren't going to,
What about life companies? Are you seeing any? Life companies, we've always kind of dealt with them a little, but they would kind of pick and choose the deals they wanted to make a run at. We're hearing rumors are coming back a little bit, but only on very Class A, top of the line, the deal that anybody else would do. I don't know if you're seeing that well.
I'm seeing the same thing. I actually, year-end, closed a deal in San Diego where a life company financed, of all things, a retail center. Really surprised me, but the same as you. Anecdotally, I'm seeing life companies coming back, but they're still on the conservative side.
Okay. And then from your clients and what you've seen, multifamily, that's who we deal with, is still the shining star, the golden goose from the stands of commercial real estate as to where they want to go. That's what we feel kind of money's being pushed into it.
Yeah.
I wouldn't necessarily call we're in a mini bubble, but I think the institutional Class A's definitely see some cap rate compression because of, like you said, all the money is trying to get allocated.
Yeah. And the institutions like apartments, because they're a little more recession-proof, businesses go down, office is going to suffer, industrial, retail, everybody needs a place to live. And apartments came through this down cycle better than the other product classes. And significantly, nobody, with a few exceptions, are building apartments right now.
Right. Yes.
We're still, gaining population. Places like Portland are very attractive as a place to in-migrate, even if we don't have the jobs. And I think places like Portland, Seattle are going to wake up in a couple, 2 or 3 years from now, and they're going to have housing shortages. And that, I think, makes apartments a very good investment right now. And there will be, a cycle where just demographics are going to cause a housing shortage, even if the economy is still kind of stumbling along.
Yeah, what we see is if we had people that could get units up, financed and construction, I think they're going to bode very well because they're going to beat the rush to come back. But as you said, it's construction financing's tight. I mean, we do have some of it coming, but it's very, very selective and very slow. So I think there's going to be an extended gap between the demand and supply, probably a little bit more extended than we typically see in a comeback of a recession because of the financing history and the memories of '09. So
Yeah.
And the other thing I was going to ask is, what have you seen different, or what have you had to change since this recession in regards to partnerships and things, or for people moving forward? Is kind of the outlook change, or how do you, I guess, are you advising people differently after what we've all gone through?
I mean, I would say for people dealing with institutions, with banks, with institutional equity partners, those guys are more careful than they used to be by an order of magnitude. So the money's there. As I said, I really think money is burning the holes in the pockets of these large institutions, but you've got to be prepared to put up with the pain. And they're going to do their due diligence. They're going to scorch the earth. They're going to leave no stone unturned. If you're somebody who can put up with all that, and some of it's smart people doing smart things, some of it's foolish people covering their rear ends. If you can put up with that and get through the process, you can be among the few people to be advancing projects. And as I said, we could come into a 2 or 3 year cycle where prices are really going to go up in the apartment sector because of the difficulty of putting deals together now.
Right. Yeah, no, there's no easy deals anymore.
No.
I mean, it's just not a, and as we say, if you can get through the pain of even going to get a conventional loan, Freddie, portfolio loan, if you can get through the pain of going through that, you're going to be sitting pretty moving forward. But the pain now is, significantly higher than where we were,
Yeah, it is.
2 years ago. Not to say it shouldn't have been there 2 years ago. We maybe wouldn't have gone as deep as we did, but it is what it is. So,
Yep.
yeah.
No argument there.
Okay. Well, I'd like to thank you for your time today.
Thank you, Greg.
Thank you for visiting with HFO-TV, and we'll see you next time.
All right.
Thank you.
Thanks.
Feel free to learn more about our firm by visiting our website or calling us directly. Thank you.
This is the Earth to World Broadcasting Network.